Hey Bowtie Nation, last week we kicked off our series for AI 2.0 with the stocks to buy in healthcare, three industries alone worth $1.1 trillion, and those AI stocks set to take market share and your returns higher. This week we're aiming higher for four industries within the financial sector worth $10.7 trillion, and I found 7 stocks that need to be on your radar. Chipmakers like Nvidia, with its 700% return in 2 years, have taken all the headlines, seeing revenue surge as they build out that processing power for artificial intelligence. But over the next decade, as we see those companies using that processing power to transform our lives, the AI 2.0 stocks are going to be in each sector of the economy. And that's where we're looking in this series. The best stocks to buy in each sector, already deploying AI to drive massive revenue growth and returns. No other sector is as primed for AI changes as finance. I mean, consider that JP Morgan alone collects $170 billion in revenue each year, and much of the sector, the day-to-day business operations of insurance, credit, and banking, hasn't changed in decades. We'll be digging into 4 of the biggest industries within finance: banking and wealth management, insurance, fintech, and credit. Within each of these, I'll show you the research on the market size, opportunities for artificial intelligence, and then reveal stocks benefiting from this revolution. And first, between property and casualty and health, insurance is a $6.3 trillion market, expected to grow to over $10 trillion by 2030. That 8% annualized growth is impressive for an industry that has been around since 1676. The US P&C market alone is nearly $1 trillion, growing at 7.7% annually to $1.5 trillion by 2030. But because of regulatory complexities and outdated IT infrastructure, the industry has failed to evolve along with technology. That sets it up for massive efficiencies and productivity as the industry adopts artificial intelligence. AI algorithms are now being trained to analyze massive data sets on everything from social media activity, wearable devices, and historical claims to guide underwriting and premiums. AI systems could automate the entire claims process, from initial filing through settlement, a process that accounts for 44% of insurers' admin costs, or about $300 billion annually. Insurance fraud costs companies over $308 billion every year in the US alone, an estimated $900 per consumer on increased premiums to pay for that fraud. AI can analyze patterns and anomalies in claims data to detect fraud in real time, flagging suspicious activity. Another study by McKinsey estimates that AI technologies could add up to $1.1 trillion in annual value to the global insurance industry, with $400 billion from pricing, underwriting, and promotion efficiencies, and $300 billion from customer service savings. First up in the industry is Lemonade Inc., ticker LMND, a $1 billion renters, homeowners, car, and life insurance company, launched in 2015 with the specific intent to disrupt that traditional model into the 21st century. Lemonade uses AI throughout its model, from its virtual assistant AI Maya that collects information and guides customers through a quote, to AI Jim, its claims algorithm, and another, CX.AI, that handles customer support. From there, several systems are also used for back-office efficiency in platform management and fraud protection. As a smaller startup, Lemonade brings the growth, with premiums up 22% from a year ago, nearly 10 times the industry average growth rate. And key here is the efficiency brought by the AI model, seen here in the Loss Adjustment Expense Ratio, or LAE, which is claims loss expenses divided by gross earned premiums, and really the core operational efficiency metric for insurers. Lemonade has been able to consistently lower its LAE, now to just 7.6%, well under the benchmark of 10%, even for large insurers. And Nation, what I like most about looking for these stocks within this next evolution of AI is valuations haven't gotten ridiculous yet. Nobody is watching these stocks for AI growth just yet, and that means you can still invest in some great prices. For example, chipmaker ARM Holdings is undeniably one of the best in that semiconductor space, along with Nvidia, but the AI frenzy has already bid these shares up to over 550 times its earnings and 51 times revenue. ARM will no doubt enjoy high growth for years, but considering something like an 8x price-to-sales multiple is fairly expensive still, ARM would have to grow its revenue by 550% just to reach that point. At its most recent quarterly growth of 46% a year, it's going to take 5 years to reach that point, and shares would still be richly priced. By comparison, shares of Lemonade are priced at just 2.3 times sales, and while the company isn't yet profitable, it's narrowing that income loss every quarter with 20% revenue growth and efficiency gains. Back to our list of AI stocks, this one $122 billion Progressive Corporation, ticker PGR, leading the way into AI among the major carriers. Progressive partnered with Microsoft to launch its Flow chatbot as a customer service tool to file claims, get quotes, and answer questions. The company also uses AI in its in-car devices to capture data on driving habits and fine-tune those premiums for each customer. This is all an attempt to capture part of that $1.1 trillion industry cost savings estimated by McKinsey, but also to grow market share through better customer experience. Progressive has consistently grown its share of those bundled market, those homeowners that also buy an auto policy, now at almost 13% of the market. Just as big as the opportunity in insurance, the global consumer finance market is expected to reach nearly $2 trillion by the end of the decade. That is 7% annual growth, with the credit card market alone expected to grow by 8.5% a year to nearly $1 trillion over that period. And here we see some of the same opportunities in AI, with Nielsen reporting credit card fraud losses topping $32 billion a year. AI can analyze transaction patterns in real time, with algorithms learning and improving over time to prevent that fraud as it happens. Consumer loans at U.S. banks hit $1.9 trillion this year, and even on a relatively low 2.7% delinquency rate across loans, low by historical standards, that's still a loss of more than $50 billion for lenders every year. AI will be used in credit risk assessment, using everything from social media activity to transaction history and economic indicators to personalized interest rates and decreased default losses. Within credit, $1.9 billion Upstart Holdings, ticker UPST, is our startup stock in the AI space, specifically building its model around artificial intelligence, with its model trained on 65 million repayment events to look at over 1,600 variables, resulting in higher approvals and lower defaults on loans. Now, Upstart is one of those train wreck stocks that went IPO during the pandemic, seeing its shares surge only to crash when valuations came out of those growth stocks. But revenue growth is expected to return to double digits next year and drive to the company's first profitable year. Shares here are already just 3.5 times on a price-to-sales basis, so in that value territory for an AI pick. Then there's the $400 billion giant of credit, MasterCard, ticker MA, also using AI, though in a more limited way to boost its fraud protection. The company is using an in-house generative AI to assess suspicious activity in real time, not only to catch fraud, but also to limit false card denials. MasterCard trained its models on 125 billion annual transactions through its cards every year and says it improves fraud detection by 20% on average, with some seeing an average 300% improvement. While returns on shares have been consistent at around 11% annualized over the last 5 years, the problem with these mega cap stocks is that even big changes from the AI use cases aren't going to move the needle that much. MasterCard will continue to grow revenue at a low double-digit pace and grow its earnings incrementally better, but likely isn't going to boom higher like some of these smaller companies like Upstart. The global fintech industry is harder to estimate because it touches a lot of those other industries within the sector. For example, Boston Consulting Group estimates the industry could grow from $245 billion to over $1.5 trillion by 2030, including digital banking, neobanking, and digital assets. Within that, fintech revenues were just 4% of total banking revenue in 2021, but could triple to 13% by 2030. And while fintech revenue growth is expected slower in the United States, it's still a solid 4x increase, or 19% annualized growth. But as AI and digitalization allows finance to cross borders, companies are going to benefit from even faster growth rates in Asia, Africa, and Latin America. Within the fintech space, small-cap Pagaya Technologies, ticker PGY, is using AI behind the scenes in credit decisions. The company uses artificial intelligence and credit risk and analysis for consumer loans, auto loans, and other products to predict customer behavior more accurately and lower defaults. It allows partners like SoFi, Klarna, and US Bank to assess loans faster and approve more loans. So where we saw Upstart uses its model to analyze and approve its own platform loans, Pagaya is a partner to lenders, a software as a service, providing its model within their loan process. With this, Pagaya limits a lot of the operational expenses, like running and marketing its own platform. That frees the company up to focus on adding lending partners and saves on consumer marketing. This is another one expected to reach net profitability next year, and with sales still growing at solid double-digit rates, it's definitely one to watch. I've saved the largest for last, the banking and wealth management side of the financial sector. Retail banking alone is estimated at over $2.2 trillion, growing to over $3.5 trillion by 2032. And revenues to wealth management could top $285 billion by the end of the decade. But that doesn't even include investment banking or commercial banking, which adds trillions more to the market opportunity. AI could personalize banking experiences by analyzing customer data to provide tailored financial advice, product recommendations, and prevent fraud. Banks are already using AI-powered chatbots and personal assistants to handle routine questions, transactions, and for 24/7 customer support. McKinsey estimates that the potential value of AI could save banks upwards of $1 trillion a year, with just traditional AI in use now, boosting the bottom line by $660 billion. What's really interesting here, though, when it's broken down by departments, the lion's share of savings is in marketing and sales and risk management. Almost $1 trillion just within these two functions. And this is a common thread we're seeing for AI across all sectors and within, that most obvious first use cases for artificial intelligence are in marketing, fraud prevention, and customer service. It's something to think about as you're looking for the AI stocks to buy in these other sectors and other industries. And it doesn't get much bigger in banking than JP Morgan and Chase, ticker JPM, the largest bank in the world by assets. JPM has leaned heavily into AI, first with its virtual assistant for corporate clients, as well as an AI assistant in its advisory business, and for fraud prevention. That AI advisor is still in development, but the company applied for its trademark in May, calling it Index GPT, and plans on using it to analyze and select investments tailored to customer needs. Now, like with MasterCard, efficiency gains from AI will only marginally move earnings for JPM at best, but with these larger companies, you get some of that safety as well. JP Morgan is going to grow its revenue and earnings with or without AI. I highlighted this next stock recently for its outsized dividends, more than twice the industry average, but don't stop there. The idea within this series is to highlight those companies primed to benefit from the AI revolution within each sector. Buying a few of the names in each sector of the economy is not only going to give you that AI-driven growth and return, but it's also going to give you a diversified portfolio for safety as well. So don't miss the first video in the series here, the 7 stocks using AI to change healthcare, and what could be a $1.1 trillion opportunity. Morgan Stanley, ticker MS, is more on the financial advisory and wealth management side, but pays one of the highest dividend yields in banking, with a 3.5% yield. Morgan Stanley partnered with OpenAI last year to create customized solutions using GPT. One project is using GPT-4 as a back-end for an internal-facing chatbot, allowing financial advisors to retrieve insight from the bot and its content library of strategies and market research. So here, Morgan Stanley isn't taking the advisor out of the picture just yet, but is kind of commoditizing them with the AI assistant. The company is also aggressively exploring other products through that OpenAI partnership, like its Lead IQ system, which matches clients. You'll also get special perks like insider access and free courses. But don't wait. The share sale is only open through July 11th, and shares are selling out fast. Don't forget to also tap that subscribe button and click the bell notification.